Hello and welcome back to the dividend wave. We are back sooner than what we expected, but there were some news that we wanted to cover, and that could be a good learning moment for our dividend investors. So Shell cut their dividend for the first time since World War II, and we wanted to have a look at the dividend cut, the warning signs that were out there, the misallocated blame that their CEO has placed, and the payout ratio. But let's listen first to what Ben van Beurden, Shell CEO, had to say about the subject.
It's fair enough that of course our dividend yield will no doubt come down, but then again our dividend yield was at a level that very clearly also signaled to the market that our dividend was seen to be at risk. So now that that risk is basically out of the way, of course we enter into a new phase.
So let's break down this statement that the yield level was at risk, meaning high. As we've seen previously, the dividend yield is the dividend paid per share divided by the share price. And if we look specifically at Shell, they had paid the same dividend for the last 6 years at $1.88 per share. If anything, there was a moment of a warning sign in 2015 when Shell failed to raise their annual dividend as they had been doing. And this is a moment that a dividend investor should analyze carefully and think in a conscious decision if to keep or to sell their shares. So on this side of the equation, nothing has really changed. Dividend paid has stayed flat. So logically, the dividend yield could only have gone up if the share price has gone down. And yes, that is the case. So the investors over the last few weeks have been willing to pay less per share as they have been seeing that the investment is riskier. So Shell CEO is essentially blaming investors for the high yield, and Shell as a company, in a circular logic, delivers a cut to the dividend that proves the risk investors were seeing. And to further prove the risk was not out of the way, as the CEO of Shell was mentioning, is that since the cut, the price per share has gone down a further 17.6%, whereas the broader market has only corrected by 5%. So actually, we think that the metric that saw this coming is elsewhere. So one metric that explains part of what is going on, and one that we definitely recommend that you look at when investing in dividend stocks, is the payout ratio. And the payout ratio is the dividend per share divided by the earnings per share, which in turn is the net income or profit divided by the total shares outstanding of a company. If we look at Shell, they have paid over the last 4 years $7.52 in dividends. And if we look at their earnings per share, we are showing here the 3 types of earnings per share that they publish on their annual reports, which is the basic earnings per share, the basic current cost of supplies earnings per share, which is a metric commonly used in the oil and gas industry, and also the basic current cost of supplies earnings per share excluding identified items, which are typically one-off items such as divestments, impairments, or restructuring. In any case, if you look at the total of those basic earnings per share, you are able to see that they are lower than the dividend. So essentially it means that Shell has been paying more out in dividend than what they have been making in profit. And this is expressed in the payout ratio, where you can see that it is higher than 100%. So essentially somewhere between 101 and 112%, depending on which of the earnings per share you would use. So essentially not sustainable long term. And with this downturn of the economy now, this will just get worse very quick. And this is one of the reasons that Shell has chosen to cut the dividend by 67%, was to preserve cash and use it during this downturn. So Make sure that you screen for payout ratio when looking at your dividend paying stocks. Make sure as well that you take a longer horizon than just 1 year, because 1 year may be misleading. Take a longer horizon, we recommend at least 4. And also see the impact of the earnings reported. So depending on what type of items they may be in there. For example, a gap and a non-gap. The non-gap is similar to this, excluding identified items that may involve restructuring and other one-off costs. So in summary, this is one of the reasons why we believe Shell had to do this forced dividend cut. Not a happy day for dividend investors, but we hope it shed some light into the subject. We hope we enjoyed. Subscribe, give us a like, and we will see you soon. Thank you.